Hi, I'm Phil Pustiowski with FreedomMentor.com, coming to you from one of my favorite places on earth up here in Key Largo. My company name Freedom Mentors because I believe that a mentor is the secret to achieving anything that you want to achieve in life, and ultimately to me that's freedom. Okay, so today's video is the top 5 tips, tax tips for real estate investors. Tax tip number 1, I'll give you a little disclaimer, I am not an accountant. I am not a tax professional, so tip number 1 is get a professional. Get a CPA, a certified public accountant on your team. But not just any CPA. You want to work with a CPA who is also a real estate investor. That's what my CPA is. He owns property. He also buys and sells property. So he knows both sides. He knows the long-term investing strategies and the short-term. So that is tip number 1, get a CPA. Now, where do you find these people? You can talk to other investors. You can go to your local real estate investing club. You can ask other CPAs, ask around, and you're going to have to dig because there's not that many of these people out there. But they are there. So you got to believe they're there, and I am assuring you that there is one in every state, if not a whole lot more. And it's really state specific. So even if you don't have someone in your town, so long as they're in your state, you're in great shape. That's tip number 1. Tip number 2, and probably the first thing that your CPA is going to tell you is you want to separate your short-term investing strategies from your long-term. Short-term is less than a year. Long-term is more than a year. And what that's going to look like may be different for each and every state. So your CPA will help you with that. For example, in the state of Tennessee, if you own real estate in an LLC is really popular amongst most small business owners. The problem in Tennessee is if you own rental property in LLCs, you have to pay a franchise and excise tax of 2.5% of the asset value. That's a lot. So if you have a $100,000 rental property, you're going to pay $2,500 a year in extra state taxes. That can eat away all of your cash flow. So you don't do that. In fact, I know a gentleman in Tennessee that has 300 single-family homes he owns in his personal name. Why? Because he doesn't want to pay that FNE tax. He wants to avoid that, and he can't because it's sole proprietorship. That's one of the loopholes. So that's an example of the fact that each and every state is going to be a little different, but you want to have one entity, whether it's an LLC, an S-Corp, sole proprietorship, a general partnership, in one side, and then for your long-term investing, a different strategy. And if you're going to use a sole proprietorship or a general partnership, you want to talk to an attorney about liability protection. The gentleman I was mentioning to you, he actually uses a general liability insurance policy. That's what protects him so he doesn't get sued by his tenants. So that's number 2, separate the short term from the long term. Number 3, what you want to make sure you do is get organized. That's probably the last thing you want to hear. You probably say, well, Phil, I'm not organized. I got news for you. The IRS will punish you. They will punish you if you're not organized. So here's how you do that. Use QuickBooks. And if you don't want to learn QuickBooks, hire a bookkeeper. But they're pretty cheap these days. You can find a bookkeeper that has a lot of clients. They'll just add you to the list. So get all of your income, all of your expenses, everything digitally into QuickBooks. Now, the next thing you want to do is make sure you pay nothing that's business related with your personal. And any income, make sure it goes into a business bank account. So separate your personal from your business. It's not simple, but some people make a lot of mistakes there. Separate those, okay? And if you think that's taken a long time to do that, one of the most exciting things about QuickBooks is that when you have a bank account, let's say Bank of America, and there are some others, the credit cards with maybe a Capital One or something like that, every transaction automatically be imported into QuickBooks with just a few clicks of the mouse. So that makes your life so much faster. But the number 1 reason why you need to get organized is because it's going to show you things you would not ordinarily see. That is reporting. How to really make money in this business. You know, I learned so much from studying my QuickBooks. I look at it at the end of the year and I'd say, well, wow, I made a lot of money on this deal. I made no money on this deal. I did a ton of work here and like no work on this deal. So I learned a lot about real estate just by studying my books. That's the main reason to get organized. That's number 3. Get organized. Okay, Your next step, so what have you done so far? You found a CPA. Excellent. Next, you've separated the two short-term and long-term, and then you've gotten organized. Number 4, own rental property. Rental property is amazing. You can depreciate most of your cash flow in those cases because technically you get to your tax basis is, which is what you paid for the structure part of the property. So $100,000 property, your tax base is maybe like $90,000. You get to depreciate that over 27 and a half years. That's like $3,200 a month. I mean, a year. $3,200 a year? That's usually how much you're going to make in cash flow. That means that whatever your cash flow is, depreciation, offset that. So you don't have to pay taxes. It's amazing. Now, again, I'm not a tax professional, so you may have to pay taxes. I'm just saying it's the best income out there. I love it. I love my rental income because I get to keep so much of it. So little of it goes to the IRS. Hey, it's completely legal. The IRS, they're the ones that have the depreciation. Now, also, when the property appreciates, you're not paying tax on the gain every single year. You're paying the tax if you sell it. You don't have to sell it. You can do a 1031 exchange and do a bigger property. You can exchange 4 great houses for 1 red hotel. So get rental property. That's number 4. Get rental property. And then the last piece is you want to income like the wealthy. You ever heard people say, probably politicians, they're doing their campaign debates, they usually talk about how the wealthy pay so little in taxes. Well, technically they pay a lot in total sum in taxes, but their percentage is a lot lower than the middle class. Why? Because they earn investment income. Investment income. Very, very different. Investment income in terms of long-term capital gains taxes, as well as rental income. Long-term capital gains is 15% right now. It's going up to 20%, but that's still a lot less than a lot of people's ordinary income tax at their marginal tax rate. So you want to do a lot of long-term capital gains. That's what the wealthy do. And the way you do that, for example, in real estate is you can buy a property, fix it up, lease it to somebody for a year in 1 month, and then sell it to them on that 13th month. Then it's been over a year. Voila, you have long-term capital gains tax on that gain. So number 5 was you want to earn money like the wealthy because they pay a lot less percentage-wise in taxes. All right, well, I hope you enjoyed this video from gorgeous, beautiful Key Largo, Florida, whereby tomorrow morning I will be fly fishing for bonefish on the flats just behind me, and hopefully the wind will die down a little bit so it'll be a lot easier to catch them and a lot easier for me to see them. And I hope you enjoyed these top 5 tax tips for real estate investors because it's not always how much money you make. It's a whole lot more about how much money you keep. I enjoy you having me here and listening to me. My name is Phil Bustiowski with FreedomMentor.com. Check out my YouTube videos. I do a lot more just like this, a lot more real estate investing tips. And check out my website. I got a lot more tips on there as well. Thanks so much for watching the video.